Good afternoon, ladies and gentlemen. Welcome to the Barometer Readings monthly conference call. At this time, all participants are in a listen-only mode. Following the presentation, we will conduct a question-and-answer session, at which time instructions will be provided. For operator assistance during the call, please press *0. I would now like to turn the meeting over to Nick Hamilton. Please go ahead, Mr. Hamilton.
Thank you, Steve. Hi, everybody. It's Nick here. Welcome to the Barometer Readings monthly conference call. It's our pleasure, as always, to provide a refresh of our macro observations relating to market leadership and how we're positioned in various themes within our portfolios. On the call, as always, to provide an update is David Burrows, our President and Chief Investment Strategist. And also joining us is one of our newer additions to the investment team. It's my pleasure to welcome Paul Campbell, Vice President and Head of Research, on the call. As we've said on the last few calls, the market framework seems to be playing well into our favor, with correlations falling and the opportunity to press on very targeted themes. What's more is that the shift in market leadership, which we witnessed starting about 15 months or so ago, has allowed us to showcase the appeal of our nimble tactical mandates, the newest of which is the Disciplined Leadership Equity Fund, a fund that is only $18 million in size. The income space has also required a watchful eye, and we've been proactive in moving the high-income portfolio towards sectors which benefit from an improving economy, and it's a theme that continues to be very important. So at this point, I'll turn over the call to Dave and to share his current thoughts, and we'll hear from Paul as well. Dave?
Great. Thanks very much. Thanks, folks, for signing on to the call today. What I thought I'd do is just give a quick recap as to what's been going on so far year to date, some of the small changes we've been making in the portfolios and how things are progressing. As a lot of you will recall, we spent a lot of time last year talking about the transition that was required in the high income portfolio, really from a world of interest rate proxies, things like REITs and pipes and telcos, to things that had somewhat more economic sensitivity. Breadth models for sectors like the financials showed improvement steadily all the way through last year. Healthcare, some consumer sectors, and some industrials. And if you looked at the portfolio at the beginning of the year with things that were highly predictable, with very little economic sensitivity, and pretty significant dividend payouts, at the end of the year, the portfolio was much more straight equity focused on companies that had lower dividend payouts, but with somewhat more economic sensitivity. And as a result, we saw very, very good dividend growth all the way through last year. And we're fortunate to have a pretty solid return against the face of a rising interest rate environment. A lot of that was driven by the fact that we were seeing improvement in breadth in equity markets as a whole, specifically developed markets. And as we came into this year, a portfolio that was set up for slightly higher economic growth. If you look at how things have progressed from the beginning of the year to today, the portfolio sort of has continued to morph along the way. Energy infrastructure has continued to be a very important theme, and that really has been a theme since I think we could probably go back 4 years. Secular theme where increasing oil and gas production required additional infrastructure, and the players in that space just have continually been able to make investments in new assets that give them strong returns, and that isn't changing. Keyera, Pembina, AltaGas, these are fixtures in the portfolio that continue to be IPL. Of course, Pembina coming into the index. Financials were a big position in the portfolio at the beginning of the year. They continue to be, but interestingly, through the course of the quarter, they've become more focused in asset managers, companies that benefit from improving flows into equities, insurance companies, and some financial tech. Less weighting in banks, and the bank weighting that we have is skewed towards a couple of the Canadian banks and regional bank exposure in the U.S. So just on that, of course, after the close, we got the news on the stress tests and the Fed's views on capital plans. Interesting, just as an aside, without having spent a lot of time on it, it looks as though the banks with big capital markets exposure and big global exposure have had the most difficulty, and the biggest win appears to be for the regional banks, which largely came through with no problems. And I think there'll be more work to do on that. But we've been largely focused away from the big global banks. Beyond the financials, though, we have been increasing our weight in some of the sectors that benefit as the economy continues to strengthen. You know, if you look through the course of the quarter, largely the economic surprises were coming into the downside. Many people questioned whether that was weather or whether it was actual weakness in the economy. I think the fact that the cyclical sectors in general held up quite well so far over the course of the year against the sideways sloppy market, you know, is somewhat positive. We have been increasing our exposure to energy and industrials and basic materials. And when I say basic materials, these are chemical companies and lumber companies that tend to do better when the capital spending increases. So basic materials, energy, and industrials have become a bigger slice of the portfolio. REITs have remained about the same, and we have been bolstering with sectors like the airline industry, consumer, and technology. So again, the portfolio at the end of the year was equity focused. It was a little more economically sensitive, a little bit more focused to dividend growth. I would say the portfolio from the beginning of the year has become even more economically sensitive, more mid-cycle oriented securities, and we continue to see very good dividend growth. Dividend payout ratio in the portfolio has moved down over the course of the year, targeting greater ability for dividend growth. And the portfolio is behaving very well. I think the income portfolio is up just under 4% on the year, and we're pleased with that. With very low volatility. Let's talk about equities as a whole. There have been a few things for people to worry about over the course of the quarter. You've had what's going on in Crimea and Russia. You've had some concerns in developing markets, slowdown in China, some currency issues, credit issues in South America. But largely, when we look at global breadth, it has been rock solid so far this year. There have been no deterioration, not a lot of improvement. Market basically is market time sideways against some of those challenges. But in general, the leadership, you know, has been pretty solid. Coming out of last year, we were largely focused in secular growth, technology, some consumer parts of the market, some healthcare. Again, those continue to be important sectors for us, and we've seen little pullbacks in some of the leading names, some of the higher multiple names. Very little by way of trend break. But what we are seeing is money continue to rotate towards things that are, again, like the income portfolio, a little bit more economically sensitive. So energy has become a bigger part of the portfolio. Weaker Canadian dollar has been a really good thing for some of the Canadian energy producers. Specifically, as we've talked about for some time, the higher growth folks that have been able to add reserves and add production. So companies like Crew, for example, or Tourmaline, or Diamondback Energy in the U.S., Matador Resources are performing very well. So energy, I guess, at this point is the largest weight in the equity fund. Again, strong weight in financials. Similar discussion. We've got insurance, we've got regional bank exposure, and we've got asset managers as a focus. Oil service or energy service, companies like Core Labs, companies like Payson Systems have been performing well. But then again, a strong technology focus, semiconductors and software making up good parts of the portfolio, aerospace and airlines, and industrials. So this structure that we see right now is a pretty sound equity market, pretty strong breadth readings, very little by way of concern. Certainly markets are seeing small pullbacks. We talked at the end of the year about the fact that if we are in fact in a new secular bull market, the pullbacks are shorter in nature and shallower. There appears to be money underneath the surface that's prepared to step in. And we've seen very little significant change in leadership in the market. What I'd like to do is I'd like to introduce Paul Campbell for a moment. He could just introduce himself and his background. Paul joined the team, I guess about 6 weeks ago.
Yes.
And you'll hear more from him as time goes by, working with the analysts and portfolio managers on the research side.
Very good. Thanks, Dave. So just very briefly, my role here at Barometer is officially as head of research. So I'll be working with the analysts and portfolio managers and the group overall on due diligence, themes, idea generation, and that fits very well with my background. I came from BMO Capital Markets as Director of Canadian Equity Research. I have 24 years experience in the industry. Started out as an equity research analyst in 1990 at Burns Fry, a predecessor firm, one of the many stockbrokers that have disappeared over the years into a merger. I was equity research analyst for 8 years. I covered real estate, conglomerates, non-bank financials, a variety of special sits. So I really covered the waterfront as an analyst. In 98, I left for 2 years to manage Canadian equities at an investment counselor here in Toronto, managing pension fund money. So I did that for 2 years. In 2000, I returned to BMO Capital Markets into research management, and I spent 14 years there in total, first as Associate Director of Research and then as Director of Equity Research. So clearly my background and strength is in research, and I'm looking forward to bringing that to Barometer, just in terms of added capacity and helping to bring some new ideas to the group in terms of that. As well, I have responsibility as co-manager of the Barometer Global Tactical Balanced Fund, and looking forward to meeting many of you, and very excited to be here at Barometer. Thanks very much.
Thanks, Paul. So just quickly to revisit some of the premises we've been working on to look at progress. First of all, came into the year with strong equity modeling, strong breadth readings. That continues to be the case. We looked at what may drive equity markets going forward. One of them was that there was a very strong earnings yield versus the yield in a 10-year bond, meaning equities as an asset class attractive from a valuation standpoint. That continues to be the case, where the earnings yield in the S&P continues to be close to 2 standard deviations above normal, making the asset allocation decision easy for value-oriented managers toward owning equities. Our view was that low inflation supported higher PE multiples. We continue to see very weak inflation data. In fact, in Europe, to some extent, one would say the risk is to the downside in inflation. We see developed markets continue to outperform developing markets. Our focus continues to be in developed markets. We continue to see very strong energy production growth, holding down energy costs for both manufacturers and consumers. That favors consumer-led economies. We continue to see good flows into equities on a monthly basis. We continue to see that household ownership of shares is still at historically low levels, meaning that there are buyers under the surface, even though money is working its way into equities. We see that our breadth readings globally still are in the mid-50% range, a long way from the 70 or 80% that would put it overbought. And all of these things are positive. None of them preclude the possibility of short-term corrections. We're always going to get those. In a bull market, you tend to get short, sharp corrections in leading sectors. We've seen over the last 2 weeks some pullback in technology and social media and biotech. That is to be expected. We don't see significant breaks in those groups. After about 3 months of reasonably consistent economic surprises to the downside, in the last week we've had 4 key economic pieces of data come out beating to the upside. So we think this does support a continued move into more economically sensitive parts of the market. And one of them would be a newer theme for us, and I'll just spend some time on that. We have seen over the last few weeks improving data when it comes to construction spending and capital spending. So there's Census Bureau data that looks at the percentage of construction spending being spent on highways and streets, and that's just recently broken out to a 12-year high, and that benefits engineering companies and construction companies that focus on road building and bridges. So one of the newer positions in the portfolio is Granite Construction. Granite Construction almost exclusively is in the business of doing work on roads and bridges. It also doesn't hurt that there's likely to be a very large spending bill come over the course of the next few months going forward on infrastructure, and certainly it's been a hard winter. We can expect to see lots of spending in repairs. Non-residential construction spending as a whole, as a group, has hooked higher over the last 3 months after being somewhat sideways over the last 14 months. That is capital spending taking place. We know corporations are chock full of cash. There has not been a lot of capacity build, and there's also aging infrastructure for corporations. So some of the companies that benefit there would be companies like Manitowoc Corporation that makes cranes, another newer investment for the firm, and United Rentals, which is a position we've had on now for 3 or 4 months. So we have been building exposure in this space. It does take a little bit of money away from the pure growth sectors and makes the portfolio a little bit more cyclical, but I think the data supports it, and certainly the stocks are performing very, very well. So if I were to just summarize, it in some ways is steady as she goes. Not major changes to the downside in any of the key sectors we're focused in. In small steps, incrementally, we continue to add a little bit of economic sensitivity in the portfolios. We're staying on the same themes, developed markets versus developing markets. Our U.S. exposure continues to be substantial at about 65% of the equity portfolio. And dividend growth as a camp continues to be a dominant theme across both our equity and income portfolios. So happy to take any questions that you might have. But certainly we appreciate the trust that you put in us, and we look forward to another year where we think it's likely we'll get some earnings growth and some multiple expansion and see some pretty solid total return in portfolios.
Great. So before we get to Q&A, just say a few things. So firstly, thanks, Dave, and hopefully that introduction to Paul was good for many of you to understand the context of where he'll fit in and the skill set he brings to the table. So as Dave mentioned, we do continue to observe what we believe is early stage bull market, which is not free of volatility. And it's worth revisiting Dave's point that we have been buyers of these dips of late, and these dips have been fairly short-lived with ample bids beneath the surface. Based on our observations, following the short corrections we have seen, money does seem to come back very quickly to the leading names and sectors, and our technical indicators are all still broadly supportive, so that's constructive. Global markets continue to be quite polarized with pockets of strength and pockets of weakness, and clearer reasons more recently to favor developed markets versus EM. And this is true with the crisis in Crimea and weaker China data of late. The Barometer discipline leadership approach we feel is very well suited for the current environment. It always places an emphasis on leading securities in leading markets, but with a process to protect investors if breadth deteriorates using our stop losses. Lastly, we continue to emphasize our income mandate as an ideal core holding for the times we're in, but we have been advocating higher equity allocations and the potential with the new nimble Discipline Leadership Equity Fund. So following the call and the Q&A here, if there are any further questions relating to our strategies, please give myself, Sarah, or Kayla a call. So with that, operator, we'll open it up to questions, please.